Hi, good morning, everybody. Listen, I have 30 minutes to tell you everything I know about the situation. That's 29 minutes too long, because nobody has a clue. We all make it up as we go. So I'm going to divide my presentation this morning into 3 parts. The first part will be about inflation. The second part will be about inflation. And the third part will be, you got it, about inflation. And after talking about inflation for half an hour, I will tell you at the end of the day, this is not about inflation. This is about the cost of bringing inflation down to 2%. The Bank of Canada, the ECB in Europe, the Fed in the US, they all established their reputation as inflation fighters. They're not going to toss it away. They will do whatever it takes, even if it means taking this economy into a recession in order to achieve that target. And that's more or less where we are. And what they care about is not really inflation, but inflation expectations. Why? Let's go back to the 70s. Let's look at this chart for a second. Focus on the left side, 1973. The oil embargo, the oil shock, inflation went to the sky. Look at the red line, that's inflation expectations. Didn't go up much. Why? Because the Fed, back then in June 1973, went to the market and said, don't worry, everything is under control. Inflation will peak in 2 months, it will go down, everything is good. Of course, it didn't happen. Inflation continued to go up and up and up for 12 months, so the Fed lost its credibility. So 1977, the second wave of inflation, look what happened to expectations. Like that, they went up. Because the Fed lost its credibility. Look where we are now. The market is trying to figure out where to go. And that's why the Fed and the Bank of Canada will do whatever it takes to make sure that this red line stays there. Because the minute expectations go up, you lose the game. So it's all about here. It's all about what we think. Now, what we think is very important. And I want to show you this. This is the first inflation wave in the social media era. Not a joke. Social media is perceived to be the most credible source of information regarding inflation. Not a joke, really, that's the way it is. So the Bank of Canada and the Fed are trying to figure out what we are thinking. We are heavily influenced by social media, which means that the Bank of Canada and the Fed are heavily influenced by social media. That's how crazy the situation is. Now, there is good news. In fact, extremely good news. The Bank of Canada has a Twitter account. No, really. The bad news is that nobody is following them. So the point that I'm making here is that the Bank of Canada cannot tweet its way out of inflation. They have to be militant in their language to make sure that we understand that they mean business. Given this background, now we can discuss what's happening in the inflationary zone. So we have a situation in which at this point there are 5 inflation forces that are impacting expectations. One of them is food prices. The other is energy prices. The third is supply chain. We all know about it. The fourth is rent. We'll talk about that. And clearly, wages and the impact on the service sector. So we have to go one by one and see where we are on those factors. First of all, let's start with energy and food. Down and down. Listen, I don't know what Putin will do next. I don't think he knows what he will do next. But the impact of what's happening in Europe on food and energy prices is now muted. In fact, on a year-over-year basis, the impact is negative. So food prices and energy prices are down on a year-over-year, which means that as far as inflation is concerned, it's a negative contribution. That's a big part of the story. And that will continue to be the story for the next few months, even more than that. So that's good as far as the Fed and the Bank of Canada are concerned. The second is supply chain. This is extremely important because at any point in time, there are 3 sources of inflation. Supply-driven inflation, demand-driven inflation, and we don't know driven inflation, like something in between. If all this inflation is coming from supply, the Bank of Canada can take interest rates to the sky, nothing will happen. Believe me, Putin does not care about the Bank of Canada raising interest rates. So a year ago, 18 months ago, the inflation that we saw came from outside. It was supply. Therefore, the Bank of Canada and the Fed were limited in their ability to deal with the situation. Today, look at the supply chain index, basically back to normal, almost back to normal. Shipping costs down dramatically. We all know that. Today in the US, you have 20% more truck drivers than before the crisis. So the situation is improving. Now, why is it important? First of all, for obvious reasons, you all understand that, but also every millimeter decline in this black line is enhancing the ability of the Bank of Canada to deal with this situation, because all the inflation is domestically driven, something that can respond to the Bank of Canada doing something. So the Bank of Canada and the Fed are more powerful because of that. That's extremely, extremely important. Another interesting thing that is happening is that gross margins are going down because of the decline or the improvement in supply chain pressure. Why? I believe that when it comes to some retailers, they were hiding behind the supply chain fog. You wanted this dishwasher, you went to the store and they said, unfortunately, we don't have one. You know, China, supply chain, you know. But if you pay a bit more, we'll find one in the basement. That's exactly what happened over there. Now, with supply chain improving, they cannot hide anymore. That's a major disinflationary force, in addition to the improvement in supply chain by itself. That's another force. So out of the three that I discussed, food, energy, supply chain, down. And that's why we're starting to see some interesting stuff. Look at the chart to the left. That's Canada. Now, what we see in newspapers and in the media is the CPI on a year-over-year basis. I don't care about that. I don't care what happened a year ago. I care about what's happening now. That's why what we do, we look at the month-over-month on an annual basis to get a sense of what's happening now in real time. Now, we look always on core inflation because food and prices are very volatile, food and energy prices. But also, in Canada, we do another thing. We take interest payments on mortgages out of the story. Why? Because think about it for a second. Housing inflation in Canada is a combination of a few things. One of them is interest payments on mortgages. The Bank of Canada is raising interest rates to fight inflation, but those higher interest rates are adding to inflation vis-a-vis interest payments. You see two forces going different ways. It's like putting a humidifier and a dehumidifier in the same room and let them go at each other. Therefore, clearly, interest payments on mortgages are not inflationary. They are disinflationary. You have to remove them from the story. When you do that, surprise, surprise, the inflation target is already there, 2%. And that's why the Bank of Canada is done. We'll talk about the Bank of Canada in a second. But basically, they are done, and they should be done. Maybe they are already overshooting. The US, not yet. Why? Because in the US, the measure housing inflation very differently. It's all about rent. For people who rent, clearly, rent is the inflation figure. What about people who own? They say, listen to this, they say, let's assume that you rent your house to yourself. What will be the cost? Rent. All of a sudden, 40% of core inflation in the US is rent. Now, look at this chart. Rent in the US now is rising on an annual basis 6, 7, 8%. That's the black line. On an annual basis. This is monthly what you see here. Which means that if all other prices tomorrow will be zero, everything else will be zero, inflation will still be 3.6% in the US just because of rent. Now, look at the blue line. That's the flow of new leases. You see, the black line is all leases, the stock of leases, all of them, and it's still up. Look at the blue line. That's the flow of new leases, zero. Zero inflation. Rent, new rent is not rising because there is enough supply there, and we'll talk about it in a second. Supply is rising with a major implication on your business. So we have a situation in which every day that passes, more of the blue line, the flow, gets into the black line, the stock. This is not a prediction. This is not maybe. This is a given. The black line will go down because it's just pure math. The flow is impacting the level, and therefore rent inflation that is 40% of inflation in the US, core inflation, is on its way down. A major disinflationary force that I think we have to recognize in just a question of time. It's starting to happen already. So the US inflation story will start looking even better than it is now. But there is one more item to discuss, and that's the labor market and rent inflation that is 80% wages. Here we have to go deep into the situation. Every first Friday of the month, at 8:30 in the morning, we get the employment numbers from South Canada and the US. 8:30 in the morning, first Friday of the month. So at 8:29 in the morning, every economist is sitting in front of his computer, looking, waiting, anticipating the numbers. Believe me, it's very exciting. And what we look at first is the vacancy rate. 1 million people in Canada, vacancies, 11 million in the US. Where are they? Where is everybody? You know, people say they are all at home watching Netflix. You know, they are not. You look at the participation rate, it's back to normal, especially among young people. So something big is happening here. So we have to ask ourselves a question, and that's something that I start with every time I look and think about the situation. And it's relevant to whatever you do. To what extent COVID is an event or a condition? Let's pray that medically speaking, it is an event. But economically speaking, it's definitely a condition. It accelerated so many trends like e-commerce, you know, working from home, we know the story. This is a condition. And it impacts the labor market as well. Let me give you one statistics which I find fascinating. We created 900,000 new jobs since the beginning of this madness. 900,000 new jobs, up and down, 900,000. All of them, not 99% of them. All of them are university-educated individuals. Interesting. I think that COVID opened up the labor market for educated people. You see, in the past, you were in Montreal, you were educated, you were unable to find a job, you were serving coffee at Starbucks. We all know the story. Today, you are in Montreal, you are unable to find a job. In Montreal, you can find it in Alberta, in Toronto, in Vancouver, Zooming. So the share of people with high education, relatively high wage, is rising. At the same time, that people that are exiting the labor market, 55 and over, and we are in a wave of retirement, on average, low education, low wage. So there is this change in the composition of the labor market that is, in my opinion, long-lasting. And that's a structural change. We'll have, you know, the demographic story is very clear, but clearly COVID accelerated that trend. But I wanted to look at this. This is the very famous relationship between vacancies and the unemployment rate. Before COVID, it was the blue dots. And clearly, whenever the unemployment rate is higher, the vacancy is lower, and vice versa. Look what happened during COVID. The curve went up. You see the black dots. That's the abnormality of COVID. For a given level of unemployment, vacancy was much, much higher. But I want you to focus on the left side and see what's starting to happen. it's starting to move in the right direction. The black dots are getting closer and closer to the blue dots. That means that the market is starting to normalize. Another factor is what we call the Phillips curve, the relationship between the unemployment rate and wages. Again, the black is before, the blue, totally crazy, during the pandemic, couldn't find the direction. Look what's happening lately. The blue is basically touching the black, which means that the market is normalizing. Now, there is no question that there is shortage in terms of low-wage individuals. The lower the wage, the higher the vacancy rate, no question about it. But the question is to what extent all those vacancies, or some of them, are one big mirage. Because otherwise, wages will go up in a very significant way. In Economics 101, they tell you the first day, if there is a shortage of something, the price of this something will rise relative to other prices. We have a shortage of low-paying jobs. We cannot find them. So according to this, low-wage individuals should see a significant increase in their wage. So we look at it. Bottom 20, bottom 40% in the job market, they're getting a nice increase, but not higher than anything else, which means that the market is not clearing. Economics 101 is not working. And the question is why? And we did focus groups with small businesses that employ 80% of those individuals. And we ask, and they say two things. One, in 2018, minimum wage went up dramatically in many provinces. We don't have the margins to raise wages now. Second, economists like yourselves, they tell me, are telling us that a recession is coming. We don't want to raise wages 5 minutes before a recession, which makes sense. So the market is not clearing. And that's actually good news as far as the Bank of Canada is concerned, because if the wage pressure is coming from beneath, from the bottom 20, it trickles up, and it's more inflationary. If it comes from the top, it doesn't trickle down. So this is less inflationary as perceived, because it's really not happening. And that's why, although we have the strike today, overall wage inflation going down in Canada, not up, at about 4.5%. We'll talk about productivity in a second, because you can maintain 4% without inflation if you do the right things. But before that, we have to deal with the Bank of Canada. So the Bank of Canada is looking at all those inflationary forces and trying to figure out what to do. The Fed is doing the same. Now, there is a big difference between Canada and the US. Canada is more effective when it comes to monetary policy. Why? Because of two reasons. One is that our mortgages are for 5 years. Theirs are for 30 years. So the impact is more immediate in Canada. Second, you have to go back to 2008. The mother of all recessions led to the mother of all deleveraging in the US. Their debt-to-income ratio went down from 160 to 140. In Canada, it was not our recession 2008. We were basically second-hand smokers back then. Our debt actually went up. So we have more debt, more sensitive to higher interest rates. I'm more sensitive. I estimate that 1% increase by the Bank of Canada is equivalent to 2% increase by the Fed in terms of the impact on the consumer. So what I'm telling you here is that the tiny Bank of Canada is more powerful than the mighty Fed when it comes to monetary policy, and you can see it in this chart. Effective interest rates in Canada, actually how much people pay, higher than in 2019. In the US, it's not. Which means that the US has to run faster to stay in the same place. And that's why we see the US raising interest rates higher than Canada, because it makes sense. However, how much more? Because can the Bank of Canada divorce itself from the Fed? If the Fed goes crazy and goes to 6.5%, can the Bank of Canada just sit and do nothing? That will take the dollar to the 60s. We don't want that. So we estimate that the Bank of Canada will be willing to tolerate 100 basis point spread, not more than that. And then they will raise interest rates despite the fact that we don't need to raise interest rates, just because of them. 100 basis points. Now we are 25 basis points. The Fed is talking about another 25 basis points, and in a very twisted way. The banking situation in the US is helping the Bank of Canada, because the banking situation in the US means that now the market is rewarding liquidity, not credit. So banks in the US are not lending. That's a recessionary scenario, which means that the Fed does not have to raise interest rates because interest rates are rising in a different way vis-a-vis monetary conditions because lending not happening. And that's why we are talking about the Fed another 25 basis points, calling it a day. Before the banking situation, it will have been another 100 basis points. So ironically, the Bank of Canada does not need to face that dilemma to raise interest rates just because of the Fed. And that's why the dollar is protected at this point. Not only is the Bank of Canada more effective vis-a-vis the US, the Bank of Canada is more effective vis-a-vis itself in the past. 1987, 1990, John Crow, the governor of the Bank of Canada back then, raised interest rates by 650 basis points, killed the economy and the housing market. Today we are at 425, less. No, it's not. If you adjust the 650 back then to today's debt level, in terms of interest payments, it's actually 300 basis points. So today, the increase is more significant than the one that led to the 91 housing market crash. That's how effective monetary policy is. So when I meet with the Bank of Canada, and I meet with the Bank of Canada very often, unfortunately, no, really, they believe in what they call constructive ambiguity. They never give you a straightforward answer. You ask them for the telephone number, they give you an estimate. Believe me, it's a pain. But the Bank of Canada is looking at it, and I'm telling them, listen, enough is enough. You don't realize how powerful you are. There is more coming in the pipelines from the past. The magic of interest rates rising is working with a lag. What we are seeing now is only a part of the story. More is coming. So you don't need to raise interest rates. In fact, I suggest, and that's extremely important from your perspective, especially if you care about the US economy and the housing market there, every economic recession over the past 40 years was helped, if not caused, by monetary policy error in which central bankers raised interest rates way too much and killed the economy. Why? Because inflation is a lagging indicator. Inflation is telling you about the past. In the past 5, 6 recessions, inflation peaked 6 months after the beginning of the recession. So inflation is telling you about the past. Inflation is like this brown spot on the banana. By the time you see it, it's way too late. So the point that I'm making here is that we need to stop here. And that's another factor that is impacting the psyche of the Bank of Canada. Now, what is complicating it is this. The Canadian consumer is loaded. During COVID, we got transfer from the government. We didn't spend anything. All of a sudden, you wake up, and we are sitting on no less than $160 billion of excess cash in checking account, savings account. That's significant. So that's a buffer. Usually, interest rates go up, the consumer slows down. But now there is so much pent-up demand, especially for services, they say, you know what? We'll take the money from checking account and spend it. Now, a lot of it now is not as liquid as it used to be because people are blinded by the 5% GIC rate that they get, and they put it there. So it's moving from checking to GIC. That's why not as liquid. Nevertheless, extremely important. So the consumer is stronger than perceived, something that will make it more difficult for the Bank of Canada to move. Now, there's another factor here, and that's, of course, the housing market in both countries. The number one factor impacting your business is the housing market in the US, no question about it. And if the Bank of Canada, if the Fed does not go crazy and stop very soon, I think that this housing market will be fine, especially in 2024 and 2025. I think that most of the damage in the housing market is done already. And we are seeing basically some improvement. And that will be the case when interest rates stabilize. Because when I speak to developers, when I speak to people that are interested in renovation, and we do a lot of focus groups on that, what they care about is not just the level of interest rates, but clarity about the direction. Developers are saying, we want just to know what the cost is, and then we'll do business. I cannot do business when interest rates rise on a daily basis. So this stability is extremely important, and we are getting very close to it, because those inflationary forces are behaving. So I'm actually very constructive from a midterm perspective on demand for your products, because I think that the US housing market, there is so much demand there, will be there. In Canada, even worse, in terms of demand. It will be much higher because of this. We got, last year, no less than 950,000 new arrivals into this country. This year, I estimate it will be more than 1 million. Those are new immigrants, non-permanent residents, foreign students, people from the Ukraine on a 3-year visa. 1 million a year. And none of them is carrying their house on their back. We are in a major, major crisis here. I will not get too much into it, but people have to wake up. People have to wake up. We need more supply of housing urgently. And when I say housing, I don't mean just people buying a house to live in. I'm talking about rental, and I'm talking about purpose-built. I'm talking about apartment buildings. I want to create a situation in Canada in which you are 35 years old, you are married, you have 2 kids, and you are renting, nothing is wrong with you. The way it is in Berlin, the way it is in London, the way it is in Manhattan. Renting must be part of the solution to the affordability crisis, and it is a crisis that we are facing. You go to Sweden, a peace-loving nation, people are demonstrating on the streets. We are getting there. Affordable housing is a major crisis that we are facing. And a rental solution must be part of it, and that's why we encourage the government, and I'm going to meet with them, to provide incentives to developers to go purpose-built as opposed to condos. Regardless, the demand for lumber coming from the US and Canada over the next few years will continue to go up, in my opinion, and renovation definitely there. So that's the demand story. Now, there's another factor here that I want to discuss. Interest rates. They are at 4.5 now in Canada. When are you cutting? That's the next question. The market is anticipating the Bank of Canada to start cutting in the second half of the year. That might be a bit too early, because the Bank of Canada would like to make sure 100% that that inflation is dead before they cut interest rates. Remember, expectations is everything. You don't want to create a situation in which you are moving prematurely. They want to make sure that inflation is dead before they're cutting. So let's say early 2024. By how much? We started this madness 175. 4.5 a year cut. How much? I say 275. Full percentage point, maybe more, higher than before. Why? Because there are 4 inflationary forces cooking in the background. We used to have globalization that was disinflationary. Now we have deglobalization. We used to have just-in-time inventories that was disinflationary. Now we have just-in-case inventories, which is clearly inflationary. The labor market back then was giving in cheap. Today the opposite is the case. And let's face it, all those green initiatives, at the margin, they are inflationary. So you have 4 inflationary forces in the background. The target is still 2%. We can discuss until we are blue in the face to what extent they should raise the target. Not going to happen. So 2% is target, 4 inflationary forces cooking. By definition, interest rates have to be higher to keep that target at 2%. And therefore, I say 3.275, a new normal. And let me remind you that the housing market, both in Canada and the US, can do extremely well in this environment as long as you have clarity. And all those forces that I discussed are also impacting margins, profit margins. Because globalization was good for business, for profit. Just-in-time inventory was good for profit. All of them are now moving the other direction. Wages. 2 minutes, I'm just warming up. What it means that for the first time, corporations have the necessity to invest and increase productivity and replace labor with capital. And I believe that after this madness, over the next year or two, after that, when we have clarity, we'll see a wave of investment coming to this country. Because for the first time, it's not just nice to do, it's actually a necessity. Because all those forces are impacting your bottom line. You will do something about it, and this something will be to increase productivity vis-a-vis replacing labor with capital. And if I give you a 10% increase in your wage, and you're 10% more productive, that's not inflationary. Productivity is the #1 protection from inflation. And that's more or less where we are, and I believe we are going this direction, and clearly that's the only way out as far as inflation is concerned and the ability of this economy to grow. Productivity, we have to take more risk and invest. So as you can see, after all this madness, what was normal in the past is clearly not normal in the context of today's economy. Okay? Thank you very much for your attention. Now, if you have any questions, you think I'm totally out to lunch, we have this flying microphone thing.
Yeah.
So don't be shy, please.
And we have a question on the platform. I may start with this one, and we'll go in the room after. Carl Gilbert is asking, when you look at vacancy rates, do you have information on the wages? Are they low wage jobs or high?
Yes, so the correlation is very clear. The lower the wage, the higher the vacancy rate. So the demand is for low-wage individuals. You will expect wages to go up for them, but it's really not happening, which means that I don't think that those vacancy rates tell you the whole story, because it's easy to list vacancy, but show me the money. And if you're not willing to pay, maybe you don't need this person. So I think that's the way to look at it.
Interesting. Questions in the room with the flying mic? If there's none, maybe I have a few. You want to go? Sure. Go ahead, Sven, please.
Yeah. Question about bad surprises from the economy, like the bank defaults that we have seen.
Yeah.
Do you see anything more of that?
Who knows? There are a lot of things that can go wrong. One of them is disinflation can be more persistent than perceived, especially service inflation, that will lead to overshooting in a recession. Because now, if we get a recession, it will be a wannabe recession. It's not going to be a real recession, because the Bank of Canada at 4.5, we are fine. But if something happens with inflation, you know, food prices, energy prices, like international crisis, then they will have to continue to raise interest rates. Then all bets are off. Then you get a full-scale recession with some blood in the labor market. So that's the two differences. Basically, a wannabe recession consistent with today's interest rates, and overshooting that will lead to a more significant recession. Other factors, of course, the situation in Europe can get worse. Taiwan, China, another factor. The debt ceiling in the US, although I think they will drive us crazy over the next few days, but eventually they will reach an agreement. Many things can happen, but this is the main case scenario. More questions?
Yes, we have one here. Would you like to introduce yourself?
Yeah, my name is Ashraf Dimitri. I'm from Total Pallet Solutions. We talked today about inflation. I just want to get your intake about how for our government to be proactive going forward. Reactionary.
Yes, regarding inflation, I think that the only way to do it, quite frankly, the only way to do it is to make sure that you don't spend too much, because again, we have government spending while the Bank of Canada trying to slow down the economy, so you go against each other. You neutralize each other. The other is productivity. The only protection from inflation and to increase the size of the pie is productivity. As a country, as an economy, we have to take more risk. We have to reward risk-taking. And we are lagging the US. And if productivity goes up only by 2%, you can get another 2% wage increase, and then it gives you 4% wage increase without inflation. I'm fine with that. 4% every year, people will love to have that. But for this, you need productivity. So I think that the focus should be on risk-taking, and I'm a bit optimistic about the fact that for the first time, companies are, they have to invest. They have no choice. Until now, profit was easy. So the lack of profitability now and all those forces that I discussed can actually lead to a wave of productivity improvement. That's important. More questions? Yes.
Okay, so the flying mic, it's a challenge now.
Oh,
Can you
wow.
please stand? Yes. Whoa! We love it. Thank you.
Hi, as you know, Canada is a trading nation, and the one issue that you really didn't speak much about is currency exchange.
Oh, yeah.
It affects us greatly whether we're buying from suppliers outside the country or whether we're selling, and all of a sudden the Canadian dollar goes down in value. How do you think that plays out in the future?
The reason why I didn't mention the dollar is because I have no clue. I'll tell you why. I spent 4 years of my graduate studies studying something called the PPP, Purchasing Power Parity, which is supposed to tell you where the currency is going. 4 long years of my life. And it's all nonsense. You cannot predict currencies. Currencies have their own mind. Having said that, what's impacting the value of the currency on a daily basis? 2 things, commodity prices and the spread between US and Canada in terms of interest rates. Commodity prices, let's call it, neutral at this point, about 80, 85 energy prices, let's call it that. So it's interest rates. One of the reasons why the Canadian dollar was relatively weak over the past year or so was the fact that the market expected, as I discussed, that interest rates in the US will rise faster and higher than Canada because of the effectiveness of monetary policy. And that's exactly what happened. So you have the Fed raising interest rates more than the Bank of Canada, the spread is widening, and the dollar goes down. In addition, in the background, because of the uncertainty, people go to the safety of the US dollar. It's always happening when people are nervous. I suggest with the Fed tweeting about the possibility of ending, especially with the banking problem in the US, very specific to the US, that will put an end to the ability of the US dollar in general to outperform. So if you ask me, I will say the Canadian dollar will remain more or less where it is now in the next few months, and then actually will gain some ground with the US dollar actually going down. What we need is to see the Fed stopping, because now the market is still expecting them to go. When they stop, the US dollar will lose some ground, and that will give space for the Canadian dollar. So I suggest a year from now, a pure guess, that the Canadian dollar will be somewhat stronger than it is now.
You know it's recorded, right?
Yes. I know, so we'll see what happens. It's a guess. Really, it's impossible to predict currencies. It just doesn't make any sense.
Benjamin, we'll have to stop here.
Okay.
Thank you so much. We could have you for the whole morning. You're an expert storyteller. We really appreciate having you at the beginning.
A pleasure. Thank you and good luck.
Benjamin Tall.